attorney Laura Anthony, founding partner of Legal & Compliance, a full-service corporate securities and business transactions law firm. Today's Lawcast talks about the CFTC and cryptocurrencies. The SEC and the U.S. Commodity Futures Trading Commission, or CFTC, have been actively policing the crypto or virtual currency space. Both regulators have filed multiple enforcement actions against companies and individuals for improper activities, including fraud. On January 25, 2018, the SEC Chairman Jay Clayton and the CFTC Chairman J. Christopher Giancarlo published a joint op-ed piece in the Wall Street Journal on the topic. Backing up a little, on October 17, 2017, the Lab CFTC office of the CFTC published a CFTC primer on virtual currencies, in which it defines virtual currencies and outlines the uses and risks of virtual currencies and the role of the CFTC. The CFTC first found that Bitcoin and other virtual currencies are properly defined as commodities in 2015. As such, the CFTC has regulatory oversight over futures, options, and derivative contracts on virtual currencies and has oversight to pursue claims of fraud or manipulation involving a virtual currency traded in interstate commerce. Beyond instances of fraud or manipulation, the CFTC generally does not oversee spot or cash market exchanges and transactions involving virtual currencies that do not utilize margin leverage or financing. Rather, these exchanges are regulated as payment processors or money transmitters under state law. The role of the CFTC is substantially similar to the SEC. It has a mission to foster open, transparent, competitive, and financially sound markets, and to protect market uses and their funds, consumers, and the public from fraud, manipulation, and abusive practices related to derivatives and other products subject to the Commodity Exchange Act. The definition of a commodity under the Commodity Exchange Act, or CEA, is as broad as the definition of a security under the Securities Act, including a physical commodity such as an agricultural product, a currency or interest rate, or all services, rights, and interest in which the contracts for future delivery are presently or in the future dealt with, i.e. all futures, options, and derivative contracts. Where the SEC regulates securities and securities markets, the CFTC does the same for commodities and commodity markets. At times, the jurisdiction of the two regulators overlaps, such as related to swap transactions and now virtual currencies. Right now, while there are no SEC licensed securities exchanges which trade virtual currencies or any other tokens, there are several commodities exchanges that trade virtual currency products, such as swaps and options, including the Terra Exchange, North American Derivatives Exchange, and LedgerX. The Commodity Exchange Act would prohibit the trading of a virtual currency future, option, or swap on a platform or facility not licensed by the CFTC. Moreover, the Natural Futures Association, or NFA, is now requiring member commodity pool operators, called CPOs, and commodity trading advisors, called CTAs, to immediately notify the NFA if they operate a pool or manage an account that engages in a transaction involving a virtual currency or virtual currency derivative. The CFTC refers to the IRS's definition of virtual currency in its own documents, and in particular, a virtual currency is a digital representation of value that functions as a medium of exchange, a unit of account, and/or a store of value. In some environments, it operates like real currency, but it does not have legal tender status in the U.S. Virtual currency that has an equivalent value in real currency or that acts as a substitute for real currency is referred to as a convertible virtual currency. Bitcoin is one example of a convertible virtual currency. I note that neither the CFTC's definition of Bitcoin as a commodity nor the IRS's definition of a virtual currency conflicts with the SEC's position that most cryptocurrencies and initial cryptocurrency offerings today are securities requiring compliance with the federal securities laws. The SEC's position is based on an analysis of the current market for ICOs and the issuance of coins or tokens for capital raising transactions and as speculative investment contracts. In my view, a cryptocurrency which today may be an investment contract or security can morph into a commodity, i.e. a currency or other type of digital asset. For example, an offering of XYZ token for the purpose of raising capital to build a software or blockchain platform or community where the XYZ token can be used as a currency would rightfully be considered a securities offering that needs to comply with the federal securities laws. However, when the XYZ token has been fully issued, the platform fully built, its utility established, and it can be used as a form of currency, it could become a commodity. Obviously, the bundling of a token securities offering to include options or futures contracts may implicate both the SEC and CFTC compliance requirements. The CFTC primer gives a little background on Bitcoin, which was created in 2008 by a person or group using the pseudonym Satoshi Nakamoto as an electric payment system based on cryptographic proof, allowing any two parties to transact directly without the need for a trusted third party, such as a bank or credit card company. Bitcoin is partially anonymous, with individuals being identified by an alphanumeric address. Bitcoin runs on a blockchain decentralized network of computers and uses open source software and miners to validate transactions through solving complex algorithm mathematical equations. A virtual currency can be used as a store of value. However, virtual currencies are not a yield asset and that they do not generate dividends or interest. Virtual currencies can generally be traded with resulting capital gains or losses. The CFTC, like all regulators, points out the significant speculation and volatility risk. The CFTC reiterates the large incidence of fraud involving crypto marketplaces. Furthermore, there is a significant cybersecurity risk. If a wallet holding crypto securities is hacked or cryptocurrencies is hacked, they are likely gone without any chance of recovery. Although many virtual currencies, including Bitcoin, market themselves as a payment method, the ability to utilize Bitcoin and other virtual currencies for everyday goods and services has not really come to fruition as of yet. Notably, payment processor Stripe, tech giant Microsoft, and gaming platform Steam discontinued Bitcoin support due to lengthy transaction times and increased transaction failure rates. I'm securities attorney Laura Anthony, founding partner of Legal and Compliance and producer of Lawcast. Should you have any questions about today's topic, please visit securitieslawblog.com and lawcast.com or contact me directly. Inquiries of a technical nature are always encouraged.